Investor Group. In today's topic, I want to discuss with you what is an annuity income. What is the income regarding annuity planning, and how exactly does it work when someone says, okay, I want to start taking lifetime income from this account. Now, kind of what the problem lies is back in the 80s and the 90s, retirement income planning used to be very, very simple. Okay, you could essentially take your bucket of money that you've accumulated in either cash accounts, 401k accounts, IRA accounts, whatever that is, and you would have this large bucket of money that you've accumulated, and you could essentially, because you had interest rates were so high, you're able to take this bucket of money, place it into a fixed account such as a bank CD or a fixed annuity, and you would just be able to live off the interest year by year by year. What do I mean by that? Well, if you had a fixed account, you would be able to go and, let's say if you had $1 million sitting in a bucket of money, or 500,000 sitting in a bucket of money, if you had a fixed account, let's say like a 5-year fixed, like a 5-year bank CD or a 5-year fixed annuity that was paying you 10%, just for easy math, that means the first year you would make $100,000, second year you would have $100,000, third year you would have $100,000, and you could just live off of all that interest year by year by year, and then after those 5 years are done, you could take that $1 million back out, or you could leave that $1 million as an inheritance to your beneficiaries. This is just to be very, very simple, and you know, it was a really easy way of life, is because you understood, okay, I'm throwing my money into these very safe products, these these FDIC backed products, or this legal reserve system backed products through an insurance company, whatever route you decided. And unfortunately, since 2000s, we've noticed that interest rates have completely crashed. 1990s through 2000s, interest rates have hit all-time lows. So maybe instead of getting a bank CD that used to give you 10%, now if you have a 5-year bank CD, it's only paying you about 1%, right? So it's more difficult. You can't utilize those same strategies that you were once able to utilize. And same thing with fixed annuities. Is this maybe a 5-year bank CD is paying you 1% currently, maybe a 5-year fixed annuity is paying you 3% currently. And it's just essentially, it's a lot less income and a lot less effective strategy to utilize that max income premise than you used to be able to do it. So in early 2000s, individuals started flocking towards different areas. They started saying, okay, well, if I've accumulated this bucket of money and I've done it through my 401k account or my IRA account, I was mainly invested in the market. I was invested in the stock market. I would just, kind of let it ride. It was a big casino, but you know what? That casino just kept paying out and paying out and paying out. And this is the #1 mistake that a lot of individuals make, is they fall victim to something known as reverse dollar cost averaging. Okay? What that means is, if you still took that same premise of trying to accumulate your money and you tried doing that on a distribution phase, how exactly does that negatively affect you? And this is what reverse dollar cost averaging shows you. It shows you a computation of negative aspects that could completely liquidate your retirement bucket, your retirement income. And let's say if you had that same $1 million example, and now you're keeping it in the market. It's nothing fixed. There's no safe haven there. So what happens with the market? The market goes up and the market goes down. In 2008 alone, individuals noticed an average 57% drop in their mutual fund accounts, in their stock market accounts. So even if you had a small portion of that, even if you only had 50% or 30%, that's still such a large hit, and that's money that you cannot just recuperate the next year. If you have a 50% drop, if you're at $1 million, you have a 50% drop one year, and then a 50% gain the next year, you're not sitting back at $1 million. Now you're sitting at $750,000. So I want you to understand that losses hurt far worse than gains could help you when you're looking towards that actual income aspect. So with reverse dollar cost averaging, it's not only the potential loss that specific mutual fund could impact your accounts, but it's also the fees that come with it as well. You have mutual fund related fees. That's going to be an average about 1%. The other thing is an advisor, a wealth accumulation specialist, that same type of advisor that was telling you, hey, leave your money in the market, leave your money in the market. We're going to grow this for you. From 1980 through 2000, through the 1980s and 90s, you had amazing, unbelievable growth in the market. And everybody was growing money in the market. It didn't matter if they had an advisor, they didn't have an advisor. They had typical individuals had over 1,000% growth in the market from 1980 through 2000. And so for those same individuals that said, okay, must be my advisor, I'm going to stick with my advisor. Well, the advisor is going to be charging you a fee. Wealth accumulation specialist charges you on a fee known as a wrap fee. So you have the first negative of the mutual fund fees, the second negative of the advisor fee, the third negative of the downward market loss. Let's say if you just had a 10% loss in a given year, and then you're looking to take income from this account. And let's say you decide, oh, my advisor told me about 4%. That's known as the prudent man's rule. This should be a good idea on how much I could pull from my retirement account without outliving my bucket of money. Well, in this scenario, if you were to take out 4%, which is $40,000, you would have walked away with $40,000, but you would have ended up losing $160,000 worth of value because that fee still comes out even when the market goes down, and that advisor fee still comes out as well, and you're also taking out money from that account. So your value would have dropped down from $1 million all the way down to $840,000. So now you have a much smaller bucket, even though you only took out $40,000 that year. And now if you're looking to take out 4% again, it's 4% off of a smaller number. If you have another market reset, or let's say the market goes up 2%, you're actually going down 4% because you're taking out 4%. You have the fees of minus 2%, meaning minus 1% for the mutual fund fee, minus 1% for the advisor fee, and then you only have that gain of 2%, and that offsets these fees, meaning that you have a net of 0%, but you also took out 4%. So now this is further reduced, and then that 4%, you only take out less and less money. And if you have a couple of market shifts, such as 2008, if you had a 57% drop in your account or 50% drop in your account, I mean, all it takes is a couple of those shifts with these constant fees and constantly pulling from this account that you don't have any more money left. So this is, I know there's a little bit lengthy of an explanation, but this is why individuals like to leverage annuity contracts, and specifically their annuity income aspects. Because an individual wants to get set up in an annuity is mainly for that lifetime income aspect. You could do certain things where you have, you could utilize fixed accounts, kind of like that bank CD concept, through a fixed annuity, where you could live off the interest year by year. As a bank CD is paying you 1%, this fixed annuity is paying you 3%, but even 3%, you're barely keeping pace with inflation. So one aspect that's a decent idea is because you'd still have your account be preserved and protective, but the bad aspect of it is interest rates are still low. So until interest rates rise back up, it could happen, in 10 years, and nobody knows, nobody has a crystal ball, but whatever happens regarding interest rates that's when you could go back to that concept of utilizing those fixed type strategies and living off of interest only type income. Now, the other aspect that a lot of people hate, and this is one of the things that I absolutely hate as well, is you could annuitize your money. Annuitize. And what this does is you go to an insurance company and you tell them, okay, listen, I have $1 million that's sitting in a bucket of money. I want to take out lifetime income from this account. I want to make sure that this bucket of money, that I could keep living and living and living, and I will never outlive this money. I'm going to be receiving a retirement paycheck year by year by year. How exactly can you do this? So the company says, oh, that's not a problem. Give us your money, and we're going to do something known as an immediate annuity. We're going to annuitize your money, meaning you paid $1 million for an income contract. What I mean by that is, dependent upon your age, the older you are, the more favorable the return that they could give you, because statistically speaking, the older you are, the chance of you dying is going to be greater. It's just the way it is. So if you give them $1 million, and let's say that they said, okay, we're going to pay you back, $60,000 every year to the day that you pass away, you understand the first year $60,000, second year $60,000, third year $60,000, and you could keep receiving $60,000, and you'll have that peace of mind that you would never outlive that money. That money will always come to you. Even if you're living for 20, 30, 40 years, $60,000 will still be coming to you. Well, the reason why I don't like this aspect, it's good in theory, but the reason why I don't like it is because you're not only surrendering all that money, all that liquid cash, but you're now falling victim to the insurance company. In this scenario, let's say if you were to receive $60,000 year by year, and let's say you only live for 3 years and then you pass away. Well, $60,000 multiplied by 3 is what? $180,000 that would have been paid out to you. And then you pass away, meaning now your beneficiaries receive nothing. And the insurance company is walking away with $820,000 of your money. So they understand the law of large numbers, they understand how to spread out that risk, and they understand the odds of you passing away before they're going to pay out their money to you. Now, some individuals, they make out like a bandit because they just keep living and living and living, and that might be when immediate annuity or an annuitization might work out very favorable for you. But for everyone else that has that big question mark, that says, I don't know, I mean, I might have had a parent that passed away in their 70s. I might have had a parent that passed away in their 90s. Who knows exactly how, how long I'm going to live? You want to at least make sure that all the money that you've accumulated, whatever you do not pull out, goes to your beneficiaries. And this is why I like a lot of the hybrid annuities, a lot of the hybrid annuity concepts, is because what this allows you to do is it says, okay, you could go place your $1 million into a bucket. You have that flexibility of when you want to execute your lifetime income amount, meaning that every year that you wait is going to grow this number year by year by year. And it's the same concept. The reason why it's growing it is because you're that much closer to death. So that's why the company's able to, so it's what it is it's a fixed index annuity with an income rider. And that income rider is very, very key when looking at annuity income. Because in one aspect, this fixed index annuity aspect, your money could grow whenever the market goes up and gain 0%, have a 0% floor whenever the market goes down. So you're having safe, consistent growth into your accounts. And on the secondary aspect, you have a personal pension plan that you could turn on for lifetime income. In a simplistic scenario, how is this very powerful? Well, let's say if you never, all indexing strategies aside, to not further confuse you, let's say if you have your bucket of money into one of these annuities with an income rider, and you say, okay, I have $1 million in this bucket, and the company says that they're going to guarantee me $60,000. If I turn on my money within 30 days, they're going to give me $60,000 every single year to the day that I pass away. If you do it without utilizing annuitization, and you're doing it in the form of the income rider. Now, this is not variable annuities, so please understand my point. This is definitely not variable annuities with how this works. So this is hybrid annuities, fixed index annuities with income riders. If you're executing an income rider, you will get that $60,000 year by year by year by year. And let's say that same scenario, you pass away after 3 years. And let's say that you never had another gain into your bucket, into your actual account value side. Well, you would be decreasing $60,000, $60,000, meaning that after 3 years, $180,000 would have went to you, right? $60,000 times 3. Now, when you pass away, does the insurance company keep the rest of that money? And the answer is no. Your beneficiaries would be the ones that walk away with the $820,000. Now, this is in a very simplistic scenario. Understand that this is going to be an absolute worst case scenario, but whenever you go and you try to utilize these things, you try to make sure you have as much gains onto your actual account value side as possible. Now, what about the opposite ends of the spectrum? What happens if the market doesn't do anything, if you never receive gains and you keep living and you have $60,000, $60,000, $60,000, and then eventually your bucket becomes $0? Does your income stop? And the answer is no. The income, because you utilize that income rider, that income will still be coming to you year by year by year. So it's all about a big game of leverage, okay? What makes the best companies, the best contracts, as opposed to other strategies, companies, contracts, is it's all based upon you. It's all based upon your specific age. It's all based upon your specific income goal. It's all based upon the leverage, the control that you want to have at all times. And this is one of the things, this is why we have a lot of national recognition, is because we show individuals how to do this properly. We are an independent agency, so we have access to every single carrier in all areas, and we're telling you, okay, if you have a specific income goal, you have a certain safety goal, whatever that is, it's not going to be a company that we can't offer you, or at least tell you about, to say, okay, if you're 66 and you want to wait 2 years and then execute lifetime income, there's a correct company, there's a correct strategy for you. If you're 66 and you want to execute income immediately, there's a correct strategy. There might be a different company for you. So it's all about how exactly could you control the chips at the end of the day and make sure that you're leveraging these contracts the proper way. But one of my recommendations, you always utilize that interest only option, but right now, because interest rates are so low, there's nothing that's so, that's so wonderful out there that's paying you such a good fixed interest rate. The best interest rate you're probably going to see in today's times are about 3%. When interest rates increase, yes, that's going to be a lot easier way of planning, but who knows when that's going to happen, especially if you're in your 60s and you want to start taking out retirement income. You can't wait 10 years to do that, to wait until interest rates poke back up. So, I like the interest only approach only if it's correct. Right now in today's times, I really don't think it is. Also, you have the annuitization phase through immediate annuities. Immediate annuities, I don't like you losing your control. So this is why I recommend against it. But I do like the hybrid annuities. Hybrid annuities became very attractive after 2008 because it allows an individual to have a safety net over their accounts. Kind of think about a bucket with a lid over it. Anytime that you wait, every year that you wait, your bucket is going to grow whenever the stock market index that you choose increases and gain 0% whenever that stock market index goes down. On top of it, you could also attach an income rider to it, allowing you for lifetime income, just as I displayed before. So this is just a really neat way on how to look at a really neat perspective on how to see annuity income and how to really leverage the different type of options that you have available. But understand, you're not falling victim to that reverse dollar cost averaging effect. Reverse dollar cost averaging, there's no mutual fund related fees with it. There's no advisor fees with it. There's no downward market loss, and your income is contractually guaranteed through that insurance company that's offering it. So what we try to do is just educate you first, let you know about the best strategies that may work for your particular situation, and give us a call at any time. Our number is 1-800-566-1002. Because of the volume that we get into our company on a daily basis, we implemented 24/7 customer service. We are A+ rated on the Better Business Bureau, and when calling in, you're going to feel very comfortable. It's not going to be some one-size-fits-all type sales pitch. It's mainly, okay, what's your strategies? What are your goals? How exactly can we accomplish those goals successfully? And if what you're already doing is the correct route, we're going to tell you, listen, stay exactly where what you're trying to go for, and you really are on the correct route to get there. So please make sure to subscribe to our YouTube channel. We always have the most updated videos out there, and you would have access to all the new updated videos when you do subscribe. And I want to thank you very much for watching this video. Please be on the lookout for some of our other videos, and give us a call at any time. Take care.